Hello, I'm Catrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of tax strategies and business strategies, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of coaches, creators, marketers, and real estate investors. I'm on a mission to equip business founders with the financial savvy they need to grow real wealth. So buckle up and let's dive into the world of financial success, innovative strategies, and the stories that make us all want to keep pushing forward. Welcome to Craft More Cash. Let's make wealth building simple, fun, and effective. Ready to transform your financial journey? Let's start crafting. I'm Catrina M. Craft. I am a CPA and I'm a real estate investor, so I have skin in the game for over 20 years. I have been working mostly on single family residencies that I've owned. I've self-managed. And I've had 12. We just sold 3. So a little bit of money taken off the table with these appreciated properties. Also, I work with individuals who are real estate investors, from flippers to wholesalers to long-term rentals, Airbnb, 100-unit apartments, syndicators. So I have experience in a lot of different areas of real estate. The main area I want to address, and we're going to expand on this, is taking depreciation. And what happens in depreciation if you have a single family property or any residential property, you're going to get to depreciate 27.5 years. So 27 and a half years. That means that structure that you have, you're going to get to deduct as a tax deduction expenses related to depreciation of that property. That's basically saying the IRS is saying, we know that this property, as you hold it longer, that you have some items that are going to not be worth as much. It's going to allow you to depreciate it. So that's a phantom expense. Now, what is important is that when you sell that property, you have to recapture that. But there are ways, and we'll get into that you decrease what you have to recapture. So that's really important. Other types of expenses would be if you are doing Airbnb, your furniture and fixtures that are in there, your dishes, your sheets, anything that you need to supply that rental, that short-term rental to be utilized, you'll be able to deduct all of those. Also, I love to say travel, because if you are looking for properties in other places, there may be an opportunity for you to deduct travel. And what you need to do, though, is make sure you're working 4 hours. So the IRS says you have to work 4 hours, but you could look at properties. You can meet with investors. You can meet with realtors. You can meet with lenders. And I suggest you do that beforehand. You set up appointments. Don't just get there and say, oh, I'm driving around. So you really need to have a plan, have it in your calendar, and you are tracking all of those expenses from if you're taking air, if you're driving, your hotels. So real estate could be a very good investment and allow you to take deductions as well. So mortgage interest, your real estate taxes, your insurance, anything that, it's ordinary and necessary. That's how the IRS determines if something should be deductible. And that is, I know, very vague, but what you need to do is work with a real estate accountant, CPA, that understands what's ordinary and necessary in the real estate arena. It's just like a doctor. I mean, you have a specialist that may deal with heart. You have one that may deal with diabetes. So you have a specialist that understands CPAs, attorneys. I've worked with many attorneys that did not understand the type of structure that's best for real estate. So that's a whole nother conversation where you may be in a C Corp and that's not the best, holding for your real estate. So please work with an attorney and CPAs that understand real estate. There is a way that you can maximize your deduction when you have real estate, and it is called a cost segregation study. Basically, a cost segregation study is a way for you to accelerate that depreciation. So when I talked about you have 27 and a half years usually for residential property, well, the cost segregation allows you to put those in different buckets. Instead of 27 and a half years, it takes different components and it allows you to depreciate faster, which is 5 years, 7 years, and 15-year property. The reason you want to do that is because although you may accelerate faster and then you have to recapture, like I mentioned, when you sell, you know, time value of money is very important. So instead of waiting and letting the IRS use your money for the 27 and a half years, you get that money now and it can reduce your taxes. So that's helping you. Inflation. So with inflation, you may be in high inflation when you sell. So we want to make sure the tax rates could change. So time value of money, taking it now is better than waiting till later. Also, you get to deduct faster. So it's a faster interest rate. So I like looking at using the cost segregation study to really maximize. So that's the general part of it. Also, with my clients, I like to say, you know, then you have more savings. You can fund savings. You can reinvest, buy another property. And that's one thing I love to tell real estate investors. Don't stop with one property. If you get a cost segregation study done, you'll have money that you can then invest in another property. Then you do it again. Let's give an example. Let's say that you purchase a property for $1 million. I know in California, that's probably reasonable. Then what happens is instead of saying, okay, first you have to segregate the land from the structure. Land is not depreciable. So you do not get to do the land. So let's just say the land is $200,000. That leaves you with $800,000 that you have to depreciate or that you're able to depreciate and do cost segregation studies on. What happens then is of that $800,000, the range that you will get to deduct is $150,000 to $300,000. That's the normal rate. So instead of waiting and only getting 27.5 years of that 800,000, you're able to, in year one, get 150,000 to 300,000. The range is going to really depend on your components of your real estate property. What's going to happen is the cost segregation study will go in and say, okay, you have flooring. Wood flooring could be more expensive than carpet. So when you look at cost segregation, when you look at 5 years, it's anything that could be removed easily from the property and not cause any type of damage. So we're looking at carpets, we're looking at hardwood flooring, we're looking at the blinds. So all of those types of things, it will depend on how many components you have of those 5-year properties. Then we're going to look at 7-year properties. And what's interesting about 7-year properties, it could be the property that you have, the asset, plus the components that go along with it. So I'm going to give you an example. If you have a TV, that TV you take off, but anything behind that TV, if you had electrical circuits that's tied to that, that also gets to be 7-year property. So you're talking about the components of the TV, the wiring, everything to the circuit board. When it ends at the circuit board could be a part of that component in the 7-year. So that's why it could fluctuate between 150 and 300, even on a $1 million property. It's going to depend on the components that you have in that home. So 29,000. And now we're going to say we're doing a cost segregation and you're going to get a $300,000 deduction. So that's money that you will then be able to deduct. That's a deduction that you'll have for depreciation on your tax return. Now, what you need to know is maybe once you look at your tax rate, let's just say you're at a 20% tax rate on that. Okay. So it's not like dollar for dollar. It's not a credit. It's a deduction. So then you're going to say, I'm in the 20% bracket, multiply that 20% times the 300,000. That's your savings. That's actual tax you're paying less of. Now, what you need to realize, though, if you do not have that much in tax liability, it rolls over to the next year and the next year. So you're not losing it. So it's best to do a cost segregation study when you do have taxable income. But if you do not, know that it could roll over to future years. So let's assume that they have a liability still of $20,000. If they owe $20,000, and then they're going to have the cost segregation study. That cost segregation study, like we said, they're going to get a savings of, we said 20%, but I really probably think it's more like 30%. So let's just say $90,000 in savings. That's going to offset the 20 that they would have to pay. They will no longer have to pay that 20, and the W-2 money that they've already paid in, they'll get a refund on that money that they've paid in. And we did not mention, that's federal. We did not mention state. So some states allow you to use that bonus depreciation as well, that accelerated depreciation. So you could possibly get some money back on the state level. Yeah. So for most long-term rentals, the deduction for cost segregation, you can use to offset other rental properties or passive investments. So when you are doing short-term rentals, it's not passive anymore. It's ordinary. And you need to make sure that on some of those, when you're looking at Airbnbs, especially, there's a term of how much service that you're putting into the Airbnb or the short-term rental. And then it becomes ordinary. That ordinary, then you're not limited like you would be with the passive, that 150,000, and you're able to use the cost segregation really well. So I like doing, especially high income earners that cannot be real estate professionals because they just can't spend that much time. And they have other jobs that they're spending more time on. Then the short-term rentals work really well at it. Even if, and I've had some clients do this, we had a property that they lived in, they moved it to a short-term rental, and then they moved back into it, and then they moved it back to a short-term rental. So in those cases, you really have to look at what's going to make more sense, because then if you sell it and there's a loophole that if you stay in the house 2 of the last 5 years, so that's why they move back and forth, you don't have to recognize $500,000 worth of capital gain if you're married. So then you need to look at, okay, which situation is going to be better, to sell it as a rental or sell it as a resident, a permanent resident. So a couple of the downsides is, if I would not necessarily suggest you doing it if it's under a property that's under $250,000, because the cost is usually at least $2,000. So you may save $2,000 on a property that's under that amount, but it just levels out. Another negative would be if you do the cost seg and then you don't have taxable income. So then you're not really able to use it, and you've paid that money, and then you still have to recapture it when you get ready to sell the property. Recapture would be another negative, that when you sell, you do have to pay a recapture tax on this. But the good news is, if you have cost segregation studies, and say you have a 5-year or 7-year, and you sell it within 7 years, well, you've depreciated all of that. And so you need to make sure, if you have done the cost segregation study, when you sell, you do not include those amounts in your calculation for the basis, because that's now all written off. And a lot of people miss that. And a lot of people miss that if you get a new roof, you need to go ahead and remove that roof that you had off the books. And you don't pay any recapture when you do a partial disposal. And a lot of people miss that. So they're depreciating 3 roofs on their property when they should have disposed of that, not had any recapture on that, and started the new cost segregation on the new roof. So depreciation, whether you take it or not, the IRS is going to calculate that you should have. And that's one thing that, if you are not familiar with depreciation and you look at your tax return and it's not being done, you need to start doing it, because it's not an option. Even if you don't take it, the government is going to assume that you should have done it. If someone got $90,000 in their pocket, what could they do with that now? You could reinvest, make money, put it in the stock market. I mean, even if you draw 8%, that's more than you would have if you just let the government use your money for 27.5 years. And when you recapture, if you pass it upon death, then the person who inherits it gets to step up in basis. And then they don't have to pay until they then sell. If you have an estate and you plan to just pass your property, and some of the, I'm sure your clients, that's how they have inherited their property that they have now. So upon death, what happens is if the person bought it for 300,000, maybe did repairs. So let's just say it's 400,000. Plus they have some depreciation. Let's just go with just say 500,000 to make it even. So 500,000 is now the basis, which is, it's kind of like the value of the house, the IRS value, the basis. If that person then dies and he passes it to their beneficiary and now it's worth 2 million, now that person has their basis is 2 million and they can do cost segregation on that 2 million. They don't have to just do it on the 500,000. And I cannot stress enough, talk to your attorneys, your advisors, your CPAs for major decisions. A lot of times things are done and it's after the fact and it's tax time. And then I'm saying it's too late. You know, you made the wrong move. I wish you would have consulted with me. A tax strategist, which is what I am, we're looking at things before they happen. Tax prepare a lot of times is just looking at after the fact, like all the decisions have already been made. So with a tax strategist, we're looking as decisions are happening in your life, things are changing, and you're consulting with us to make those decisions. So a tax strategist is looking at how it affects your retirement. We're looking at entity structure. What's the best structure if you're starting a business or getting into real estate? Like the situation where someone is ill, terminally ill. What should you be doing now with your assets and your investments? We're looking at your return on your investments. Is it best for you to start a business or get into real estate or invest in paper or invest in commodities? So we're going to help you look at all different types of building your wealth and growing and paying less taxes. My goal is to help you pay less taxes. So I'm going to look at what is the strategy to help you do that? I want to figure out a way. And the tax code is huge. There's lots of loopholes, a lot of things people don't know. So I love working with individuals to help them strategize. You shouldn't think that a CPA knows it all, because I work with an asset protection attorney. So he's specializing in protecting your assets so that if you are sued, how do you know that you're protected? Then you may have someone that deals with trust and estates. That's a different person. Then you have a business, attorney. And then on the CPA side, you may have someone that specifically works with restaurants. I don't work with restaurants. So it is important to understand this, really specialized areas that each of your professionals have. It's very important. So I'm on all socials, Instagram, LinkedIn, Facebook, YouTube as Catrina M. Craft. And I have a special where I'm going to be doing a special class on real estate and the tax deductions. And that can be found. You can sign up for that at craftmorecash.com/real estate wealth. So craftmorecash.com/real estate wealth. And sign up there and I'll have a masterclass.